So back to the Corporate Transparency Act. So there's a 2-page handout that we gave that we've mailed out to a couple thousand of our clients already, but we wanted to go through it with you as long as you're here. So this initial slide that we have just says what we're doing with this law. It's a money laundering preventative measure. And I think it's casting too wide a net, because you're going to see who it applies to is almost everybody with a small, even with a small LLC or corporation. So if you have a business that's operating in 2024, you've got to make your report by January 1, 2025. And I'll tell you what you need to report in a second. So reports are required from business entities who are registered with or created by a state agency. So in English, that means that if you filed your initial paperwork with the Department of Financial Institutions, which you would do with a corporation or an LLC or an LLP, a limited liability partnership, you're going to be one of the people that's going to be required to report. There are some exceptions, but generally they don't cover people as much as we'd like. So it applies to all C corporations and S corporations, all LLCs and all LLPs, but not general partnerships and not sole proprietorships or, thankfully, trusts. So the larger companies with over 20 employees don't have to report, and people that are regulated already, like banks, they don't have to report. So when in doubt, think that you're going to need to report. That we do get the initial calls we've gotten from people who have questions, are wondering, aren't I covered by an exception? And it looks like you are, but generally you're not. So where do you do the reporting? You report online. When is your report due? If you were operating a business in 2024, your report is due by January 1, 2025. However, if you started your new business in 2024, your report is due 90 days after you form the entity by registering it with the State Department of Financial Institutions. If it's formed in 2025, that means next year or later, the report is due 30 days after you set it up. So if formed in 2024 or later, you must report your information about your company applicant in addition to what are called beneficial owners. So what's a beneficial owner? That's somebody with 25% or more interest in the business, or somebody who has substantial control, like if you have a manager-managed LLC, it's the manager. If you have a CEO or a COO for your corporation, or the company president or general counsel, those are all people that you have to disclose information about. You have to tell people the identity of these people. You have to prove their identity with a photograph of the driver's license or passport for every beneficial owner. But thankfully, you can file the report online. There is a how to file section on our 2-page information sheet on page 2 that gives you the website to go to file this report. So if you know somebody, or you yourself have an LLC, and we did an assignment of that LLC to your trust, you're probably one of the people that has to do this report. Hit the wrong button. There we go. So now we're going to do a little review of the Secure Act. One of the things it did, maybe I've gone back too far. Yep. Okay. So this is the same slide you had last year. The law was clarified a bit in 2022, and it sets rules for when an IRA has to be withdrawn. And if you're already taking your required minimum distribution when you die, the people that inherit from you have to start taking their required minimum distribution in the year following your death, and that's they have 10 years to get the money out, but they'll actually have to go and use a single life table to figure out how much they have to pull out each year. If you died before you had started your required minimum distribution, then your beneficiary can take it out any time over the 10 years. Do I expect anybody in this room to remember that? No. But when you have a question about it, feel free to call and let us know. There are exceptions to this 10-year withdrawal rule, and they haven't changed. Minors, that's anybody who was under age 18, a disabled individual, and they have to be found disabled for purposes of Social Security, or they're less than 10 years younger than the beneficiary. So if somebody doesn't have kids and they're leaving their estate to their brothers and sisters who are less than 10 years younger, they can use their life expectancy rather than the 10-year rule. So that slide was the one that said that the change occurred to what the IRS said about the required minimum distributions for those where the plan participant had already started taking RMDs. Now, if you don't pay your taxes on your RMDs, there's a penalty that goes with that, but the IRS is waiving that for failure to take the RMD in 2021, 2022, and 2023. But if you're required to do it in 2024, you need to get on the stick. And then here's the other big change. It's a favorable change made by the Secure Act, and that is it raised the age when the required minimum distributions must be started. It used to be, I started when I was 72 and a half, or 70 and a half. And now they've raised it to 72. In a couple of years, it's going to go up to 70. Well, it's going to go up to 73 already. And in 2033, it'll get all the way up to 70 to 75 when you have to start. So let's talk about what's going on with the gift and estate tax. This is a tax on your privilege to transfer assets to the people that you love, either during lifetime, that's called the gift tax, or when you die, that's called the estate tax. And so Congress has taken a look at tinkering with this in 2021, and a lot of times the ideas that we see floated for changes reappear. Since these ideas were floated by the Democrats, I don't think you're going to see the Republicans floating the same ideas. They'll be different. Right now, the exemption amount is set at an astronomically high level that we'll look at in a second. And it's set in 2026 to come down to half its amount. And they may do away with that sunset, and that would be nice. And so the other thing that Congress has looked at before is tinkering with capital gains and trying to do away with this, what's called the step up in basis for some people. So let's stay tuned and keep an eye on this Congress and see what they do. In terms of the gift tax, the annual exclusion amount has finally gone up from $18,000 to $19,000 in 2025. And so people generally don't know what happens when they make a gift over the annual exclusion amount. When you make an annual exclusion gift, you don't even have to report it to the IRS. But if you go over $18,000, $19,000, $20,000, you're trying to help your kid get money for the down payment on a house, you might have to file a Form 709 gift tax return. Will you have to pay any tax? No, not until you get up to that astronomical level that applies tax of, now it's over $13 million. So a married couple in 2024 could have gifted each $18,000. That multiply that times 2, one for each of the married couple. You can give away $36,000 without even reporting the tax. I wouldn't cut it too close. If you die in the year that you make the gift, the IRS may take a good hard look at what you gave away in other ways, like wedding gifts or Christmas gifts. On the estate tax, look at the exemption this year. $13,610,000. Raise your hand if you got that much money. Don't do that. Hardly anybody does have that kind of money. But I tell you, one thing that's good is that in 2025, it's going to go up. It's indexed for inflation. It's 10 million indexed for inflation. So it's going to get up to, they've already told us, to $13,980,000. The benefit is nobody has that kind of money, but if you die this year or next, you can transfer your unused exemption to your spouse. So if you're considering a death this year, next year, maybe pretty good. Your spouse could be walking around with a huge exemption to cover his or her remaining estate tax when they die. So the exemption, that's what's going to drop in 2026. It's going to get cut in half to 5 million indexed for inflation. But and then we had a dilemma for a while. We've had people pass away, and we don't know whether to transfer unused exemption or not because you have to file a form 706 gift and estate tax return. And so it's it's just an estate tax return. And it's a long, tedious thing, and it costs about $4,000 to $5,000 to prepare them. So I want to get a benefit if I'm going to do that. So we had a hard time figuring out sometimes whether it was an appropriate case for us to go ahead and tell the client, spend that money, get that transfer done now. But now the IRS, and strangely, has gotten very nice about it. You used to have to do that within 9 months of death. Now, then they expanded that to 2 years. And now they've raised it to 5 years. So you have 5 years to think about this. And so when we'll help you think about it. And you can see whether your estate's gone up dramatically in the 2 or 3 years following your spouse's death. And you may be able to go ahead and transfer unused exemption.